Welcome back to FT Markets. The big news in markets at the moment is the sharp fall in the euro and the rise of the dollar. Maybe it's the big story of the year. With me to discuss quite how sharp the euro's fall has been and what it means for global policy is Roger Blitz, our foreign currency correspondent. Roger, thanks for joining me. Tell me, the euro's fall has been quite surprising. What exactly has been undermining its strength?
Well, we have seen the real policy divergence between the European Central Bank and the US Federal Reserve come into sharp focus. What we didn't expect was the speed and the pace at which it was happening.
Just look at our chart and it shows how quite dramatic it's been this year. How much is it down so far this year?
It's down 12%. It started, obviously, its decline back in May. That's when Draghi said there was serious concern about the strength of the euro at the time. And then, as you can see, about September time, then he starts talking up the idea of easing, and the quantitative easing program starts to materialize, obviously, in January. And then we've seen in the last few days this incredibly steep fall, which is on the back of the non-farm payroll numbers coming out of the US. So partly it's about US strength.
But we also had QE actually launched this week, which seems to have not been priced in by markets, surprisingly perhaps.
No, and there's certainly the sense that the markets just haven't quite got to grips with what QE is going to mean from the European side. And clearly what we'll see is a great deal of pressure, as you know, on the bonds and how yields are going down.
We'll come back to bonds in a second, but you mentioned right at the beginning that divergence across the Atlantic. And if we look at our second chart, slightly complicated chart, but what we've done is basically looking at the difference between US 10-year treasuries and German 10-year treasuries. And what you can see is that actually that difference, the extent to which US treasuries are higher, has broadened to really quite historic levels. I think that's the highest for 3 decades. That obviously partly a eurozone story, partly eurozone QE. It's also a US story, isn't it?
Yes, the US needs to get to grips with the impact of this differential and how it might impact on their own economy. And we may see
we have the Fed meeting next week.
Yeah, so we may see US corporates starting to push back at the idea of the pressure of importing deflation from Europe.
We've seen a bit of that in US equity markets already, haven't we?
Yes, and I think what we will probably get more colour from next week when Janet Yellen speaks is will we see patience coming out of the language of the Fed.
Which would mean hikes more likely this year.
And I think what currency markets are looking at is when exactly are those hikes going to happen. There's a lot of talk about June, but some are even suggesting it might be September.
Because there's a question, obviously, how wide that divergence can go. Because if we, in fact, look at our final chart showing just the 10-year German bond yield, you see we're getting pretty close to zero. And QE has also pushed that down to really quite low levels. But actually, prospects for the eurozone maybe don't justify quite so low interest rates.
No, there's a lot of optimism in some parts of European corporate land, and there's some feeling that the QE will have a very strong effect quite quickly. But I think there's a great deal of structural problems still for Europe that the markets aren't clear that Europe is going to be tackling with very quickly.
So what's the big milestone? We're down to 105 against the dollar at the moment. Dollar-euro parity?
Parity was virtually not discussed until a couple of weeks ago, and now it's the only thing that's now being discussed, and the expectation is not only parity but actually going even lower.
Roger, we'll have to stop there. So dollar-euro parity back on the agenda on the back of euro weakness, but also those transatlantic differences.